Hello, I'm Phillip Smith, financial planner with Tidepool Wealth Strategies, guiding late career professionals into and through retirement with clarity, confidence, and purpose. Welcome to
The Perfect Retirement Plan?
Hello, welcome. Today we're wading into a topic that doesn't usually make it into retirement conversations, but probably should. Tariffs. These quiet policy levers can make loud noises in the markets. Global markets, local markets, and as that noise gets closer and closer, it really hits home, especially when it's right there in your portfolio. That's especially true if you're close to retirement. Today, we'll talk about what tariffs are, how they shake up investor behavior, and what you should be doing when trade tensions heat up and markets get a little seasick. Let's start with something real. It was April of this year, 2025. The markets were stumbling, headlines flashing red arrows, breaking news banners, economists on parade. I had over 30 client meetings that month. And let me tell you, every single one of those conversations had a heartbeat. These weren't spreadsheet sessions or just regular portfolio reviews or discussions about estate planning, cash flow, or anything else. These were gut checks. They were emotional, personal. Clients came in with worry in their eyes. They wanted to know if everything was still on track. They didn't just want charts. They wanted confidence. They wanted assurance. They wanted to know, am I going to be okay? So we looked. We compared what they were feeling with what was actually happening inside of their own accounts. We zoomed out. We walked through history together. This thing we call the wall of worry that markets are always climbing. And I showed them their portfolio compared to the S&P 500 year to date. Now, guess what? Every single one of those portfolios, 100% of them, was in better shape than clients had expected. Not one of them was down as much as the market, whether we were looking at the S&P 500 as that comparison tool or the Russell 3000, which is to look at the broader market. Nope, it wasn't even close. And this reinforced something I already knew. Having a plan matters. Diversification matters. But most of all, perspective matters. Now let's talk about what tariffs really mean for the market. Tariffs at their core are import taxes. They're used to try and protect domestic industries or level the playing field. But in practice, they can set off ripple effects, supply chain hiccups, price hikes, retaliation from other countries. Markets don't love surprises, and tariffs are often sudden, politically charged, and hard to predict. That combination spooks many investors and can send indexes tumbling. Take 2018. The Trump administration launched a wave of tariffs against China. What happened? The S&P 500 dropped nearly 20% from September to December. Headlines were dire. Pundits were panicking. But by 2019, the market had rebounded by over 30%. So basically, tariffs threw a fit in Q4, and the market had a full-blown rebound party 6 months later. And this is why reacting in the moment almost never works. What looks like a disaster in the short term can look like a bump when you're looking in the rearview mirror. Now let's move to investor reactions and overreactions. Here's something not enough people know. The average return in the 12 months after a 15% market decline is 52%. That's according to Capital Group. So if you sell when things are scary, you often miss the best part of the ride back up. From 1954 to 2024, market drops by 5% happened twice a year. Bigger drops, 10% or more, showed up every 18 months or so. But 37 of the last 49 years, positive returns by year end. Markets will stumble. It's part of the rhythm. And if you try to time every dip in recovery, you usually end up out of step. So you have to know when to ignore the noise. That's what those 30 client meetings in April reminded me of. When you anchor back to the plan and give people context, they can breathe easier. They can think again. So how do you keep a retirement plan resilient when trade tensions are rising? First, diversification. You'll hear me say it over and over again. If you're overexposed to sectors sensitive to global trade like manufacturing or tech, it's possible to feel every shock. A diversified portfolio may help smooth the ride. That's not just a buzzword. It's a defensive posture against policy whiplash. Now, second thing, take a look at bonds. Remember those? When tariffs and policy risks drag down growth, the Fed often responds with rate cuts. course, that hasn't happened this year, but historically, the Fed often responds with rate cuts, which can commonly benefit high-quality bonds. Even now in 2025, we're seeing core bond funds act as a stabilizer when equities get wobbly. Now, third, opportunity. When markets drop, good companies are going on sale. Think back to COVID in sectors like leisure, airlines, and cruise lines. This is in no way a recommendation, but consider what happened to the stock of a cruise line company whose name my compliance doesn't want me to specifically reference, but that particular stock dropped over 80%. By mid-2021, it had surged over 300% from its lows. That's not luck. That's the power of staying invested and having cash or allocation to take advantage. Of course, goes without saying, all investing involves risk, including the potential loss of principal. Past performance is no guarantee of future results. Not even a diversified portfolio can assure profit or protect against loss in a declining market. And you should always consult with your financial advisor before making any investment decisions. Okay, I think compliance will be satisfied with me throwing that in there. Oh, let's take some action on this. Number one thing that you could do is revisit your portfolio. Are you concentrated in sectors that rise and fall with global politics? Maybe take a look at that. Second thing, review your income plan. Can your retirement income weather 6, 12, or 18 months of drawdowns or slower growth? Is it built to withstand even longer troughs? Third thing you could be doing is looking for opportunity. Talk to your financial advisor about sectors or funds that are being punished unfairly when there are bouts of volatility, because volatility often misprices value. Here's the deal. Markets will always have noise. Tariffs just happen to be one of the louder instruments right now. But your plan, if it's grounded in reality and built with balance, should offer at least some confidence, even in turbulence. Now, if this episode helps you, hit subscribe so you'll have more clarity the next time the market tide pulls out. And remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity.